How's it going, everyone? Welcome to Dividend Compounders with Cheese. Today, let's go ahead and talk about UnitedHealth Group. They're one of the biggest health insurance companies in the world that has been a consistent performer throughout the ages, despite all of the legal policy changes. And by the way, I don't know about you, but where I live, spring is hitting us in full force, which means it's pollen season, and my nose has been sniffling all day as if I'm a beagle or something, and my throat is so itchy. But anyways, in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting smelly dividend stock. UnitedHealth has two business pillars, a pharmacy prescription service and health insurance. This is what they are more commonly known for. In the US, you essentially need three forms of insurance. One is car insurance if you drive. Second is insurance for your home. And the other is health insurance. There have been many startups trying to break into the health insurance industry, but the big boys have too much influence and an economic moat. UnitedHealth is one of the biggest providers by market share. The others being Kaiser Permanente, Anthem, Aetna, Cigna, etc. And this is not an exaggeration. I have known people who have joined the US military just so that their family could have health insurance expenses all taken care of. Health insurance and medical costs are just out of control, and I'm so sorry I'm about to go on a rant right now. Personal opinion, I think the medical industry needs a transformation. The whole idea of a hospital billing a patient millions of dollars for just one ER visit is ridiculous, and then having to battle with your own health insurance provider to get that bill negotiated down to $100,000 is convoluted in itself. So much like Altria, the tobacco company, I am not a fan of UnitedHealth or any other health insurance company because they are one of the primary reasons the medical industry is so complicated and profitable with pretty margins. Some people even have to weigh their options and even forego the decision to survive an illness because of medical debt based on the current system. Funny enough, I had the opportunity to join one of the biggest health insurance giants in this country as part of their MBA leadership development program, but I just could not tune out my personal feelings. However, when it comes to investing, I think the health insurance industry, no matter how crooked I personally think they are, it does not matter because the health insurance industry is insanely cash heavy, profitable operation that has the power to charge 10 times the amount on ordinary treatments and drug options compared to other countries. Whether the service and quality you receive here in the US is 10 times better, well, that's debatable, but that's the financial business landscape as it currently stands. The business model is simply amazing. They have millions of customers under their umbrella paying a subscription like Spotify or Netflix every single month or every 6 months. To make a profit, insurance companies make sure the premiums are greater than any future claims, which is known as underwriting the profit. They have whole departments and teams full of people who will calculate the financial numbers to see if it makes sense insuring someone, and to make sure that the premiums that they charge people will always be more than the surgeries and treatment costs needed. If you look at this past fiscal year, UnitedHealth just absolutely crushed it. Their revenue went up by 15% year over year, and their net margin was 6%. With that said, not all is evil with health insurance companies. In fact, the major players contribute and help with Medicaid and Medicare, which are health insurance options to make sure our most vulnerable members of our society have the ability to access health services and health care. Then again, this demographic will also be subject to the nightmare of finding a provider that's supported and covered under their insurance network. Like I said, this country needs a transformation of the health industry. Regardless, look at how much revenue and profit a health insurance company can make. Right now, we are looking at their income statement. You can see in 2023, they generated over $371 billion in revenue, and their total operating costs were $339 billion. The net earnings? Yeah, $22 billion. So no judgment from me because it makes a good business case and a good investment argument. argument. Don't feel guilty about your investment convictions. My role of nipple is to separate my personal feelings from a winning business. Just like when Target was getting burned alive at the stake last year for their marketing campaign, I saw it as an opportunity to invest in Target. Anyhow, when we look at their balance sheet, all I can say is that their balance sheet is rock solid, or as JP Morgan's CEO would call it, a fortress balance sheet that has the ability to withstand financial troubles and the flexibility to endure through storms. UnitedHealth has nearly $30 billion of cash on hand, which is absolutely wild to think about. But what about their future? Can they keep growing at a double-digit pace? Well, UnitedHealth is still confirming that their EPS growth will be around 14%, as you can see on your screen, 13 to 16%, because they are forecasting increased revenue from employer-based health insurance plans, increased coverage from Medicare spending going up, and Medicaid spending also going up. It does not matter if the medical landscape changes with AI robots conducting surgeries and hospitals running more efficiently, because humans will still need treatment, surgery, and health care. And for that service, the hospitals will send a big bill to the patients, and the patients will want coverage to help pay for their medical costs. UnitedHealth will remain a profitable, cash-heavy business, at least for the short term. All of us pay for Medicare, whether or not we agree with it. Our taxes pay for it. So the funding for these programs are safe as far as I'm concerned. So UnitedHealth, yeah, it's looking like a pretty good company. Their dividend yield is sitting at 1.5%, give or take. Their dividend payout ratio is 31%. Very healthy, which means their dividend is sustainable. Back in 2015, they paid out $1.42 a share in dividends. You fast forward throughout the years, and now they pay out $7.52 a share in dividends. And this annual dividend payment is growing at a rate of 14.7% year over year. And they have been increasing their dividend payments for the past 14 years. This, my friends, is what we call a dividend compounder with cheese. Amazing, fantastic, beautiful. And now let's look at their total performance for the past 10 years. With $10,000 invested in January of 2014, fast forwarding 10 years later, your initial $10,000 investment would now be worth $76,000. This is a CAGR of 22% year over year, meaning that your money grew at a rate of 22% on average. During their best year, the stock price went up by 45%. During their worst year, which is this year actually, it went down by negative 6%. However, to see your money increase by 700% for a health insurance company, it just shows you how delicious this company is. This is not a tech stock. This is not NVIDIA. This is not AMD or Tesla. And I know I had a lot of words to say earlier. However, I cannot deny the fact that UnitedHealth is a beautiful business, at least on paper, with personal feelings aside. Next, we're going to be looking at the shares outstanding. We want to find out if the company is issuing more stocks and diluting the shareholders, or if they're buying back shares. Buying back is a good thing. So back in 2009, there were 1.179 billion shares outstanding. And when you look at the bottom graph, it does look like they bought back their shares at a low single-digit percentage every 3 months. And this has been a consistent trend throughout the years, except back in 2017, where they did issue some shares. But since then, they have been buying back the shares. And as of today, there's roughly 938 million shares outstanding. That's still a lot. Next, let's go ahead and look at some finances and some numbers. The first thing that we're going to be taking a look at is their revenue. So back in 2015, they generated $157 billion. That's wild. The next year, they grew their revenue by 17.6% because they generated $184 billion. And every single year, they have been increasing their revenue number, sometimes by single digits and other times by double double digits. Just this past year, they generated $371 billion in revenue. Let's see if their net income is a similar story. Yes, their net income is increasing in the right direction and a positive trend. $5.8 billion in 2015 as their net income, and last year, $22.3 billion. This is beautiful. This is literally a dividend compounder with cheese. My goodness, can we just stop this video? UnitedHealth is a buy. Next, let's go ahead and take a deeper look at their technical indicators to figure out what their stock price movement has to say about the company. So judging by what we see right here on the graph, it looks like UnitedHealth goes through a cycle of being overbought, then investors taking advantage of their gains, and then overselling. So back in the beginning of March, they were definitely oversold because their RSI was roughly a 23. Anything below 25 signals that this stock was oversold. But since then, it does look like their stock has recovered and now they are trading in the middle of their Bollinger Bands. Now, I'm not a betting man, but if I were to make an educated guess, depending on the presidential election and any policy changes that might be in their way, UnitedHealth could drop down to their line of support, which is their lower Bollinger Band, at about $465 a share in the near future. Then again, technical indicators is really speculative, so I might as well have just pulled that out of my butt. But that's just based on what we see on this graph. No exaggeration, I've had to pause like 3 times while making this video so I can go blow my nose. But anyways, we have now made it to my most favorite part of the video. We're gonna figure out an intrinsic value for UnitedHealth based on some valuation models.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
So the first valuation model is going to be the multiples valuation. Essentially, we're going to be figuring out a market-derived price for UnitedHealth based on their industry peers and how the market values them. So every single one of these companies are related to the healthcare, health insurance industry. And the median PE ratio is 20.2. Now, UnitedHealth has an earnings per share of $23.86 a share. That's simply amazing. So taking those factors into consideration, the multiples valuation is $482.66. Now, they're currently trading for about roughly $490, give or take, so 482 is not out of the question. The next one is going to be the DCF model. Essentially, we're going to figure out an intrinsic value for UnitedHealth based on their free cash flow and the growth. So back in 2018, their free cash flow was $13 billion. Billions of dollars. And when you fast forward, they have been increasing it by double digits, except in 2021, where it was relatively flat. But since then, they did increase it by 17%, and then the next year by 9.7%. That spits out an average growth rate for the free cash flow of 13.8%. However, we're going to shave 1% off from that and plug in 12.9% into the equation instead. And thinking about these balance sheet numbers, that is going to give us a DCF price for UnitedHealth of $782.85. That's absurd, but let's go ahead and move on. The next one is going to be the dividend discount model. Essentially, the dividend payout and the growth rate of those dividends are going to help us figure out an intrinsic value for UnitedHealth. So back in 2019, it looks like they paid out $3.60 a share. You fast forward throughout the years, and they did increase their dividend payout by double digits every single year. So the average dividend growth rate is 20.3%. However, I'm going to tell you right now, despite that being an awesome number, I cannot plug that into the equation because we want to be a little conservative and play it safe with our numbers. And we're going to plug in 7% into the formula instead. So going forward, if UnitedHealth grows their dividend by 7% year over year, then the intrinsic value becomes $804.64 a share. And last but not least is going to be the Benjamin Graham's valuation model. Essentially, the growth rate projection alongside with the current AAA corporate bonds yield rate will tell us what the Graham's value for UnitedHealth will be. In this case, that's going to be $432.54, which brings us to the conclusion. What exactly is going to be the intrinsic value? And is this going to be a delicious dividend stock? Based on everything that we've seen so far, honestly, we can all agree and conclude that UnitedHealth is a cash-generating, dividend compounding machine that is absolutely delicious. So regardless of what this intrinsic value is going to be, I just want to throw that out there. Despite my personal feelings of not being a fan of how the current healthcare system is operated in the US, it does not matter because on paper, UnitedHealth is simply amazing. So with all that said, the intrinsic value is going to be $625 a share. So let's go ahead and compare our intrinsic value to what the Wall Street analysts believe the price target should be for UnitedHealth. Now, Wall Street believes that the intrinsic value for UnitedHealth is $577. Their low estimation is $480, and someone is just on cloud nine because they think UnitedHealth should be worth $675. He's very bullish on the company. So we said $625, Wall Street says $577. So in comparison to Wall Street, we are a little more optimistic about the future surrounding UnitedHealth. So now that we've come to the conclusion that UnitedHealth is a delicious dividend compounder with cheese, let's try to figure out what an acceptable buy price would be with a margin of safety baked in.
That margin of safety concept boils down to getting more value than you're paying.
Now, as a refresher, UnitedHealth is roughly trading for about $490 a share. Now, with a 10% margin of safety baked in, then the acceptable buy price becomes $563 a share, which gives you a discount of $73 based on a 10% margin of safety. And if you were to buy UnitedHealth at its current trading price of roughly $490, you get a 22% margin of safety, or 21. I guess we can meet in the middle and say 21.5%. That's the margin of safety that you get. So there you have it, folks. UnitedHealth's stock price might be a little high at $490 a share, but according to our valuation models and looking at their numbers, we can conclude that UnitedHealth is undervalued and they are a dividend compounder with cheese. Please do your own due diligence and research to figure out if UnitedHealth is delicious to you, because to me it is. All right, everyone, I'm going to go ahead and blow my nose again. So until next time, stay safe. Dividend compounders with cheese, signing off.